When economies collapse, headlines focus on what's destroyed. Markets crash, companies vanish, entire industries disappear. But quietly, beneath the chaos, something else happens. Some businesses don't just survive collapse, they endure it. They existed before modern finance. They survived wars, depressions, hyperinflation, and political failure. And long after the noise fades, they're still there. So the real question isn't why do economies fail? It's why certain businesses never seem to. In this video, we're going to explore the types of businesses that historically survive every economic collapse. Not tech giants, not speculative startups, but quiet, unglamorous enterprises that continue operating when systems break. We'll look at why they survive, what patterns repeat across history, and what this reveals about risk, resilience, and how economies really function under stress. Let's start with an uncomfortable truth. Economic collapse doesn't destroy demand, it reshapes it. When systems fail, people don't stop needing things. They stop buying optional things. Luxury disappears, speculation collapses, growth narratives die. What remains are needs that cannot be postponed. Food, energy, health, shelter, repair. Every collapse forces society back to fundamentals. Pattern 1. Businesses tied to survival, not growth. The first category that consistently survives collapse is businesses tied to non-negotiable needs. Food production and distribution sits at the top. In the Great Depression, while banks failed and markets closed, farms, grain distributors, and basic food processors continued operating. Margins were thinner. Credit was scarce. But demand never disappeared. People may downgrade what they eat, but they don't stop eating. Collapse doesn't eliminate consumption. It compresses it toward necessity. Here's where it gets interesting. The same pattern appears in energy, electricity, fuel, heating. During periods of hyperinflation, energy providers often shift pricing mechanisms, barter systems, or government-backed arrangements, but they remain operational. Energy is the bloodstream of an economy. As long as society functions at any level, energy businesses persist. Pattern 2. Businesses that repair, instead of replace. In stable economies, replacement thrives. New phones, new cars, new appliances. But during collapse, psychology flips. People stop upgrading, they start repairing. Historically, businesses focused on maintenance, repair, and refurbishment see increased relevance during downturns and collapses. Mechanics, electricians, tool repair, parts resellers. During the Soviet Union's collapse, entire informal economies formed around keeping aging systems alive longer than intended. Collapse rewards longevity over novelty. Pattern 3. Healthcare and basic medical services. Healthcare is another sector that consistently survives collapse, not because it's profitable, but because it's essential. During economic breakdowns, advanced elective care may suffer. Luxury medical services disappear, but primary care, emergency services, pharmaceuticals, and basic treatments remain in demand. Illness doesn't wait for recovery. In many historical collapses, healthcare providers shifted compensation models, from cash to barter, from state support to community support. But they continued operating. Health outlasts currency. But there's a twist most people miss. Not all healthcare businesses survive. Those dependent on high capital costs, imported technology, or complex global supply chains often struggle. The survivors are usually simple, local, adaptable providers. Collapse punishes complexity. It rewards simplicity. Pattern 4. Businesses embedded in local communities. Another overlooked factor is proximity. Businesses that are deeply embedded in local communities tend to survive longer than centralized giants. Why? Because trust becomes local when institutions fail. During Argentina's repeated financial crises, neighborhood businesses with strong relationships often survived while large chains struggled with supply disruptions and credit freezes. Local stores adapted pricing. accepted alternative payments, extended informal credit. Collapse turns formal contracts into social agreements. Pattern 5. Businesses that can operate with little credit. Modern economies are built on credit. But during collapse, credit disappears. Interest rates spike. Loans freeze. Liquidity evaporates. Businesses that depend on constant borrowing fail quickly. Businesses that can operate with minimal external financing survive. Cash-based operations, low fixed costs, flexible labor structures. Historically, debt is the accelerant of collapse. Resilience often looks boring. Small margins, slow growth, conservative balance sheets. Pattern 6. Businesses with pricing power and scarcity. Collapse doesn't eliminate scarcity. It intensifies it. Businesses that control scarce resources often survive because they can adjust pricing dynamically. Food distributors, fuel providers, water logistics, basic materials. But there's a fine line. Price too aggressively, and political pressure rises. Fail to adjust, and operations collapse. Surviving businesses navigate scarcity carefully, balancing profit, survival, and social tolerance. Pattern 7. Informal and semi-formal economies. One of the most consistent features of collapse is the rise of informal markets. Barter, off-the-books labor, unregistered services. These aren't anomalies. They're pressure valves. In post-collapse environments, informal businesses often outperform formal ones because they adapt faster and avoid regulatory friction. History shows that when official systems fail, parallel systems emerge. Business doesn't stop. It changes shape. What almost always dies in collapse. Now, let's look at the other side. The businesses that rarely survive. First, speculative enterprises. Companies built on future expectations rather than present utility collapse quickly. Second, highly leveraged businesses. Debt magnifies failure. When revenue drops and credit dries up, leverage turns fatal. Third, luxury and status-driven industries. When survival becomes the priority, status loses relevance. Collapse strips society down to function. A pattern across centuries, from the fall of Rome to the Great Depression to modern hyperinflationary states. The same businesses survive, not because they're innovative, not because they're exciting, but because they're necessary. Collapse doesn't reward intelligence alone. It rewards usefulness. Economic collapse feels chaotic, but it follows structure. When systems fail, society doesn't stop functioning. It simplifies. Complexity fades, abstractions disappear, and value moves toward fundamentals. The businesses that survive collapse aren't betting on growth. They're anchored in reality. They serve needs that can't be postponed. They operate close to their communities. They adapt faster than institutions. The lesson isn't to fear collapse. It's to understand what remains standing when everything else falls. Because history doesn't ask whether collapse is possible. It asks whether you understand resilience. If this helped you see economic systems more clearly and understand what truly endures beneath the surface, consider subscribing for more calm, long-form stories about money, power, and the hidden structures shaping our world. This is Cold Insight. Thanks for listening.